Have you ever wondered what it takes to successfully raise money? I have worked with hundreds of capital campaigns across dozens of industries, and I'm here to share with you proven methods for raising money in record time and at the lowest cost, while also obtaining capital at the lowest price. My name is Karl Dakin, and welcome to Motivated Money. Hello, this is Karl Dakin with the Motivated Money podcast. This is the podcast where we talk about raising capital in a manner that will get you the funding you're looking for quicker, easier, faster, and possibly at a lower price of money. Today, I will be the presenter for the entire program, and I will be talking about valuing your business. This is a common activity that's required anytime you go out to raise money. You need to be able to tell someone what is the value of your business for purposes of filling out any kind of report, for meeting the requirements of an investor, and for determining how much of your company you're willing to give up in order to get the resources that your investor can make available to you. So what we're going to talk about and go through this is that we want to start with just the general premise of valuing your business. And this will get us to our first question, so to speak, of the day, which is, what is your business worth? When you get ready to put together an offering, this is the proposal that you make to investor candidates that says, you have resources I need, Mr. or Ms. Investor, but I want to give you something of mine in exchange for that. And quite often, what you have to offer, it may be the only thing you have to offer, is a portion of the ownership of your business, which means that you're going to be talking about what is a reasonable price or value to be put on your business for purposes of making this offer. Is your business worth a lot? Is it going to be worth a fortune? All these questions come to mind as we look at this particular question, and we're going to dive into some very simple, straightforward ways today of how I go about valuing a business, whether it's my own business or whether I'm working with one of my clients. And this is a topic that will be coming up in a future workshop of the Motivated Money Bootcamp, because it's a core question to be answered going forward. So to begin with, the value of your business is not based upon where you're at today. It's based upon the ability of your business to generate profits over time, going forward into the future. So you have to get out your crystal ball. You have to polish it up a little bit and make sure that you can see it as clearly as any images may appear in your crystal ball. And you're going to ask yourself, what is my business going to do going forward? Because this is the basis for calculating the value. Now, one of the terms that you will commonly see associated with business valuations is EBITDA. This is an acronym, EBITDA, and EBITDA is a widely accepted form of measuring a value of a company based upon its profitability. And you calculate profitability in this manner by taking all the earnings of your company, deducting all of your expenses, but not all of them, actually. You're not going to include in your deductions any payments for interest, payments for taxes, any calculated or paper expenses for depreciation or for amortization. So when people say, what's the EBITDA of your company, they want to know essentially what are your profits without any counting, messing around, or bookkeeping to reduce your tax liability. They're looking more for what I would consider to be net cash flow. I think these terms are relatively similar. There are going to be some differences. We'll get into that. So every time you get ready to raise capital, you're going to need a cash flow projection. This is an activity that supports the valuation of your business, and you're typically going to forecast all the revenues, all the expenses going forward for a minimum of 3 years. I prefer to go forward 4 years or 5 years if I think that it's a reasonable projection. But with a lot of companies, particularly startup companies, even a 1-year projection is very speculative. There are so many assumptions that have to be met that even a 1-year projection is questionable, but that's what you got to do. You still have to make a projection. And the projection will be based on making a number of assumptions. You're going to assume that you're coming to work tomorrow, that the sun is going to come up in the east. You're going to have so much resources available to you, whether it's through an offering, such as you're getting ready to raise capital, or it's through earnings or other types of resources available to you. And I commonly will list out each of the key assumptions that support my projection. And when I do that, it's very common for me to have 20 minimum assumptions, as many as 100 assumptions. And I write all these out because these are the framework for how I went about making my cash flow projection. And I want to make sure that I have all these frames in place. And right now, where we are entering into a deeper recession and we're seeing a major entrenchment taking place within the capital industry as a consequence of high inflation, ever higher interest rates. And this is impacting the ability of people to borrow money or to obtain equity investment. And investors are spooked. They're saying basically, we don't like to make investments in unstable times when it's chaotic. And so a lot of investors are not making investments now, or they're making more conservative investments, and meaning that they've set the bar higher for what they need to see before they will make an investment into a business. And even when they do make an investment, it typically takes more time. So all these are impacting your ability to raise cash today. And all these things need to be taken into consideration as an assumption when you're raising capital, because all of these things may impact your sales, it may impact your profits, it may impact your ability to hire and recruit talent. It may impact your operations, interruptions in your supply chain. All these are part of your assumption base, but you'll end up as a business with a document that says, here's my best guess at where this company is going to be 3, 4, 5 years down the road, and what is the net cash flow that I am projecting or anticipating I will be able to achieve with my business over this period of time. And whether you call it net cash flow or EBITDA profits, that is a choice that may be dictated to you by your investor. They may ask you to go back and redo your books to follow the format they're looking for. Now, in this, what you'll then end up with is you will end up with a dollar amount, which represents the profits that you expect to make in year 1, year 2, year 3, and possibly years 4 and 5. I don't look for profits going beyond years 5 because that is, in my mind, so speculative that no investor is reasonably going to rely upon or lean on those numbers. They're going to want to see what you're going to do in a relatively short term of 3, 4, or 5 years. Now, the cash flow projection is there. And say, for instance, in year 1, you have $100 of profit. Year 2, you have $200 of profit. And years 3, you have $400 of profit. This indicates that you're doubling your profits year over year over the next 3 years. And this is another important factor that we will take into consideration in setting the value for your company. So what we will find is that investors use a multiplier. That is, they will look at the profits and then they will determine how much profits you're going to earn going forward, because this becomes the basis for the value of your company. If you think about it this way, if a person puts up $100,000 investment into your company, they are anticipating they want to get their $100,000 back over this time period, 3, 4, or 5 years, and they want a return on that investment. That is an amount of money over and above the amount of their investment, which represents a percentage, often stated as a percentage of, hey, if I put in $100,000 and I get back $120,000, that's a 20% rate of return if that's all accomplished within a 1-year term. So if they're investing today and they're saying the price of the company, the value of the company, should be equal to the profits that are earned in each of the next 3 years, and I use the example that I just gave of $100 in year 1, $200 in year 2, and $400 in year 3, then the total profits of the company are going to be $900 in 3 years. And that $900 represents the value of the company that a investor may reasonably expect to see. And then we get into the question of how much of those profits do you need to give up to the investor in order for them to attain their investment goal of, say, 20% per year rate of return. If we can do the math at this point in time, and we can determine what percentage of the company, what percentage of that $900 profits is needed in order to pay back someone a 20% rate of return over 3 years. So assume that a person puts in $100 and you're going to pay them 20% per year, which is $20 over 3 years. Then at the end of 3 years, that investor will expect back approximately $160 on their investment of $100. And that gives them the rate of return they're looking for. And then if you know that you're going to make $900 during those 3 years, then you calculate what percentage represents $160 divided by $900, and that tells you the ownership percentage that you will be required to give up to an investor who is seeking a 20% rate of return on their investment of $100 over a 3-year term based upon your cash flow projections. So at this point, it should be very clear that these cash flow projections are very, very important because this is the foundation upon which the investor is going to assign a price that they're willing to pay. Now, the multiplier effect is that if you have a company that's making $100 of profit this year, an investor may assign a value equal to the profits over the next 3 to 5 years. So again, if you're making $100 of profit this year on your company, then an investor may assign a value of $300 to $500 as the current value of the company, because that is the amount of profits that they expect that they're going to get over the next 3 to 5 years. And that's if it represents their percentage of the profits. So we're always going to be making that 2-step approach, first calculating out what is the value of the company, and then what percentage of that value needs to go to the investors as a percentage of ownership of your company. So if we're looking at this value proposition of 300 to 500% of your current profits, that is considered a low multiplier. It's kind of a standard common multiplier, 3 to 5x of the company's profits. If it's a mature company that's not growing, it's plateaued, and all the profits in the future are considered to be basically the future looks a lot like the past. If you made $100 of profit the last 3 years and you're expecting you're going to make $100 a year going forward, then a 3x to 5x or 300% to 500% multiplier is commonly going to be used for pricing the company. And then depending upon how much the investor has put into the company, how much rate of return they want on that investment, you're able to calculate what percentage of ownership of your company you have to give up in order to get that investor on board. If we are seeing a company that is in a high growth rate, and this is something that is very common to startup companies, high growth companies, tech companies, where the first year there may be no profits, first 3 years there may be no profits. But at some point, because of growth, because of high market demand, we may see these profits climbing like the hockey stick, the common metaphor for a high growth company. And in that case, we're going to use a different multiplier, meaning that we now expect, because of growth rates, that this company is going to make more than 3 to 5 times the current year's profits, that in future years, these profits are going up, and therefore we're going to use a larger number as a multiplier. And in a startup high growth company, it's common to use a multiplier of 10 to 20 times profits because it's expected that this growth rate is going to continue, and every year thereafter, profits are going to go up. And we're trying to determine what would be a good multiplier to use in that particular case. Now, in the example I used earlier, where we started with $100 profit in year 1, $200 in year 2, and $400 in year 3, we're seeing a doubling every year in growth of the profits, and therefore we're also going to anticipate that in years 4 and 5, we may continue to see this high growth rate, which means that if an investor puts in 10 times the profits of year 3, they still expect they're going to get back their money whenever they cash out of that investment, because the growth rate of the company will continue and they're going to have a larger participation in these profits that are going to come forward. So this is something that you will want to look at as you do your cash flow projection, and you're saying, here's what I expect my profits or net cash flow is going to be at years 3, 4, and 5. And if you see that you have this growth rate, this high growth rate that indicates that you're going to have more and more profits in the future before your company finally matures and its growth rate flattens out, then you can use a high multiplier and assign that to the value. So what I commonly do is I will look for that point in the future where I think that the company is going to be performing well, but still growing fast. It hasn't slowed down its growth. It hasn't indicated that it's basically done all it's going to do. And then I ask myself, okay, which year do I want to pick? And I will commonly pick years 3, 4, or 5. I will take the profit or net cash flow for that year, not the cumulative or aggregate since we started the investment, but I'm going to be looking at that particular year, 3, 4, or 5. And then I'm going to pick a number that I think is a reasonable multiplier of those profits. And I will assign a value to this. And if the company is growing very fast, I commonly will do somewhere between 10x to 20x of the profits that exist in that 3rd, 4th, or 5th year, whenever I think the exit is going to occur. And now I have a value for the company based upon my cash flow projections, which in turn are based upon many, many assumptions. But this represents my opinion of where the company will be, what it's going to be able to achieve, what kind of outcomes it may expect in terms of profits. And I'm applying a multiplier to that. So if I take my example again of this company that had $400 of profit in year 3, and I assign a 10x multiplier to that because of its strong growth rate over the next 3 years, then at that point, 10 times 400 would put a valuation on this company of $4,000. Now, going back to my example earlier, if somebody invested $100 into this company and they wanted a 20% rate of return, then they would like to see at the end of year 3 that they get back their original investment of $100,000. They get back their rate of return, which is $60,000 or $20,000 per year for 3 years. So $160,000 represents what they need to see to hit their investment goals. Now we can divide 160,000 by the new valuation of $4,000, and that ratio represents the percentage of ownership of the company that I would be expected to give up to this particular investor in order for them to attain their goal and for me to gain access to the resources, the investment that I want them to make into my company. And so in this regard, basically what you have to do is you start off doing a cash flow projection. You will come up with an outcome of at some point in time in the future. I prefer 5 years, but it depends on the company and where they're at. We may be going a shorter time of 3 or 4 years. With the cash flow projection, I will take the profits or net cash flow for that last year in my projection, and I'm going to multiply it by a number which I think reasonably represents the ongoing growth of this business. So at the very minimum, a non-growing company will be worth at least 3 times profits in that last year. And at the maximum, it might be as much as 20 times the profits in that year, which all go to show that we're often going to have potential disagreement on valuation between me as the business owner and the investor. And so the last point that I need to make in today's program is that every investor is going to use their own valuation formula. If you've got your books and records in good accounting order and you have a good cash flow projection, then you should be able to match whatever valuation formula that the investor wants to apply. Now, depending upon the investor may be able to dictate to you which formula is going to be used. In some cases, you may be able to use your own formula in putting a value on the company. But all formulas are based upon future profits, on future net cash flow, and that becomes, as I say, the core or foundation for putting a value on your company. Now, here's where it gets harder, because investors, in particular angel investors, institutional investors who do this on a more regular basis, they're going to apply a discount to whatever cash flow projection you have. They're going to take your number, and it's not uncommon for them to say, well, I'm going to discount that by 1/3 or 1/2 or even as much as 2/3. And essentially what they're saying is that your cash flow projection is too optimistic. You've set your outcomes higher than they think is reasonable, and they are going to talk to you about a lower valuation because they are going to accept a lower number as the profits or net cash flow that you may be earning in that 3rd, 4th, or 5th year. Now, beyond that, depending upon your company, the industry, the economy, a variety of other factors, investors may make other adjustments. They may say, well, I think that you didn't take this into account in your cash flow projection, or yes, this projection will be true if the economy was in good times, but I think we're in for a major bump here, and I think it's going to negatively impact your cash flow projections for at least the first year, and that cascades over into your next 2 or 3 years. And so there will be a point where you may have put a valuation on your company, and that valuation is not acceptable to the investor. The bigger dollar the investor, the greater amount of money that they're investing relative to your capital campaign goal and relative to the size and history of your company, the more the investor can mandate or dictate what that value has to be for them to participate. But there should be a rationale, there should be a formula for setting that, and sometimes there's not. I have seen investors walk in a startup deal and say, my rule of thumb is I get 50% of the company for my money. And there is no attempt to do a cash flow projection. There is no true attempt or effort to set a value on the company. This is just a knee-jerk criteria set by some investors who think their money is more important than your business. And what's interesting about this approach is that the investor may have paid too much for your company. It may turn out that if they'd done a cash flow projection, that 50% is not enough to achieve the rate of return that they would like to see on their investment, and vice versa. They may have paid too little. And your goal as the business owner is you want to push the valuation as high as you can, reasonably, based upon what you think you can do. And you take into consideration also what you can do if you get this investment in the door, which can be a game changer for you. But the net of that is that you will be placing a value on the business. You're the driver of the car. You know which direction it's pointed. You know how hard you're pushing down on the pedal, and you know how much gas is in the tank. And if this investment puts enough gas in your tank to extend your distance or to increase your speed, then this is all taken into account in your projections. And so what I wanted to do here today is to walk you through this framework for placing a value on your business, particularly in the setting of talking to investors. Because with this valuation, you can now determine, based upon the expected ROI to the investor, what percentage of your company you would have to give up. And if it turns out that your company is so early, or it's burning its profits up as it grows because it's scaling so fast, some investors will not see any significant profits occurring even in 3, 4, 5 years down the road. And they may be uncomfortable, or you may not be able to come to an agreement with them on what percentage of the company you want to give up in order to get their investment. This is where you may see a different structure in your offering, which may be something based upon revenue, a revenue share style agreement, or you may enter into a loan where they will provide you money and you will pay them back in interest, which is not tied to profits and is not tied to revenue. It's strictly a contractual obligation to pay a percentage of the investment at a certain rate per year for the term of the loan. So nonetheless, all things being what they are, you always are going to need a cash flow projection. You should always keep this in mind in putting a valuation on your company. And the assumptions upon which you create your cash flow projection are the basically the fort that you have to defend if an investor candidate disagrees with your valuation. You have to explain this is a reasonable assumption, this is more likely to occur than not, or this is guaranteed, or there is little risk that this assumption will not be met on an assumption by assumption basis. And this gets you back to supporting and justifying your cash flow projection with that and your potential growth rate, then you can use a multiplier on that net cash flow or profit in the future to put a price on your company that would represent what you might sell the company for today, in part or in whole, to any investor or buyer that should show up and start talking to you about doing something with your company. So that's it for today. I appreciate everyone being with me on this Motivated Money podcast. For those of you who like to do homework, if you have not done a cash flow projection, please do one now. Take the time to look into the future, to try to determine all the variables and factors that could influence or may dictate to you how much profit you may make over the next 3, 4, or 5 years, and then look at your growth rate and look at values or prices that may be set on other companies growing at the same or a similar speed. And with that, you can start putting a defendable, supportable price on your company. So that's it for today. Thank you for joining me on the Motivated Money podcast.
Thank you for listening in to Motivated Money. If you like this or any other episodes, make sure to leave a rating and review the show. We love to hear your feedback and want to make this the best possible show for you. Also, if you like this episode, make sure you share it with someone you know who is seeking to raise capital. They will appreciate learning what you now know about raising funding. I'll see you on the next episode of Motivated Money.